So here we're going to discuss the breakout tactical patterns. And highs and lows are very important. I really call them turbulence zones because you get a lot of information from them. So a lot of the shaper patterns are breakout oriented, such as the cup with handle and the flat base, high tight flag. But here we're going to look at short-term variations of those, but from different points of view and different areas of the chart. We don't always have a breakout at new highs. But when we do take out highs, it's how we do it that matters. So if we stumble across with very low volume and we can't hold the breakout, that really announces to the trading community that the buyers are no longer in control. So that's why they say, failed moves are fast moves, and typically we go the other way very quickly. That explains why there's so much frustration when you're buying these breakouts and moments later you're sitting with a loss. So although they're a key tool, it's important to know that at these breakout points, you really want immediacy, you want follow through. It should be really breaking through that prior resistance. And although there's that frustration, the reason you want to use breakouts is that you can't get to $100 a share from 50 without going through 51, 52, and 53. You have to break out to new highs at some point. And you know clearly at that point when you're breaking through highs that buyers are in control. So you want to walk that fine line between that confirmation of breaking out above prior resistance and being chopped up in the meantime through false signals. So I tried to narrow it down to several key breakout patterns that you can use in addition to shapers that are not as obvious to everyone or have such an important catalyst that there will be follow through and you're less likely to be chopped up in a bad market. So the first pattern I want to look at is the buyable gap up. Now, a lot of these patterns are not completely new that you never heard of before, but what's really important is the whole context and how you bring things together. So the importance of the buyable gap up is you really want to see it gapping out of a base, and you want to have some kind of catalyst, a news catalyst or an earnings catalyst. So there has to be that there was that basing structure, that shaping structure where demand and supply was at an equilibrium, and this just totally shatters what was the situation prior to this news announcement. And one of the best ways to deal with buyable gap ups, there's multiple ways. This is a really tricky pattern to work with because the volatility really expands when the gap up happens. But it can't be ignored because so many huge moves really kick off with a gap up. So you want to be aware, you just want to have the proper framework to use to take advantage of them. So step one is you want to see it breaking away from a shaper base. The reason you want that is gap ups later in a trend can actually be a form of exhaustion. Prices are going up so much for so long and people just can't take it anymore. They all jump in and there's a gap up on some kind of news that's been anticipated by the market for weeks. And that's really the blow off top. So the fact that you're buying this coming out of a base is that basing structure is really what provides that substantial upside once the gap happens. So this is how I approach buyable gap ups. And I typically like to buy the gap open. And if I do buy the gap open, I'm going to place my stop midway of the range. So for example, if this were to be a $5 gap, I'm going to put my stop $2.50 lower from where I open it. So really just it's a matter of seeing where the open is and calculating the difference. In this case here, it was a $7 gap, so $3.50 is the initial risk, which is the midpoint. And this occurred on Facebook. This is early in 2013 when Facebook was really getting rolling. And you can see this was an earnings gap away. A lot of these tend to be earnings gap aways because the earnings report is just that moment where you get this key information and people realize if the fundamentals are accelerating or not in the direction of trend. And although you had the opening, sometimes people find it difficult to buy the opening gap. And so you can wait for the closing price. And if I wait for the closing price, which you could have here, what I do is I then keep a very close stop. I put my initial stop at the gap opening. So basically I'm buying it on the close, but I want immediate follow through the next day. We'll look at another way of using gaps later on, which involves a pullback. So I've noticed that gaps are going to be one of two things traditionally. Either you gap and you just keep running and you keep going and that momentum really takes hold, or you're going to gap and you're going to consolidate. So if we're going to go into the consolidation phase, there's no use taking a big loss. You might as well quickly exit, let the stock settle down, yet you don't want to ignore it because that doesn't always happen. In this case here, Facebook gapped up, closed strong, and just really took off. So if you bought the close and you had your stop at the open of that day, you had a very small initial 90-cent risk. So very quickly you had 5 times that risk. And not too long afterwards, you had 22 times that risk. So you can see that if you play it from a momentum perspective, and keeping that loss really small, there may be a lot of frustration because given the volatility, you may be stopped out, several times trying this. But when they work, it's really, the upside is really fantastic because you really have that runaway momentum. So it's really a matter of personal preference. Some people just absolutely want to be in on the gap. Some days the stock gaps up and it really runs all day. So buying on the close actually has you paying a much higher price. Both are possible. It's really a matter of personal preference. So I tend to buy on the open. Some people prefer to wait for the close and use that tighter stop. There's no reason why you can't use a combination, why you can't buy the open, and if we close strong, you just raise your stop immediately to the opening of that day. That's also a possibility. But let's take a look at some more gap examples, and you can really see how powerful a pattern it is and why you need to pay attention to it. This here is Fastly, and this is one of the stocks that really helped me do so fantastic in the 2020 US Investing Championship, and we had earnings here as well, and I did buy this gap up here. I was actually even buying a little bit in the pre-market. Those are probably some more advanced discussions. But we had a powerful 27% gap up due to earnings. So sometimes people just see this large gap up and they're just so scared to buy because, wow, it's already up 27%. But the fact that the stock is gapping so hard means that there's really some incredible new information that hit the market. I mean, if you look at the size of the volume, this daily volume was far superior to any other day you had for months, even throughout the entire crash phase of the COVID pandemic. So for the fact that we gapped up with a 27% gap with that kind of intense volume really meant that investors were piling into this stock. And so it does seem like, perhaps like, wow, it's up quite a bit, but very quickly you have 5 times your risk. And soon after that, you have 22 times your risk again, so, coincidentally the same as what Facebook had done. And I bought the open. I had my initial risk $3.25 lower. That's the way I had played it out. But again, you could have played this with a closing price as well. And this really just ran away. So again, this is something that you cannot ignore. This gap up buy around $29. Only a few weeks later, you were sitting at over $100 a share. So it's really something you don't want to ignore and pay attention to. I just want to note again that this gap was not later in the trend. This gap was coming right out of this shaper pattern. So it's important that you have that strong basing structure before the gap happens. This is Lululemon. This is another stock that I had traded back in 2010. As much as possible, I would try to bring in stocks that I actually had personal experience with. We had earnings as well for this gap here. And you can see as well, the volume bar was substantial. It was huge. This is the biggest volume bar in weeks. And we were coming out of this double bottom basing structure. And the stock was somewhat lagging the market. We were making lower lows, whereas the market was not making lower lows. But oftentimes earnings report really provide the stock that opportunity to change its dynamic with the market. So whereas Lulu was not necessarily a leader at this point, this gap really changed everything. And so again, it was an 11% gap up, and you could have bought the open or you could have bought the close. This kind of just ran away from thereafter. And if you use it on a closing basis, you very quickly had 10 times your risk. Now, we kind of consolidated sideways a little bit, and we had another gap away on earnings just 1 quarter later. And you weren't right next to a basing structure, but if you were already in a position from the prior earnings report, this provided a great way to add additional exposure to the stock that was proving that it really is accelerating its business. And so we had another 11% gap up. Whether you use the opening price or the closing basis, both ways you had a very controlled risk with 95 cents or $1.54. And again, you very quickly had 5 times your risk and then 20 times your risk. But what's important to notice, and why, again, you can't ignore these gap ups out of a base, is when we first gapped up here, we were in the $20 area, and a few months later, you're trading at $60 plus, and this stock went higher. So that's a triple. That's just an enormous move. And starting off with a position right as that move kicks off really puts you in a position of strength to add and build this into a big position that can substantially impact your portfolio. Here we're looking at Netflix, again, another stock that I had traded back in 2010. I actually did not trade this part of the up move, but this was the double bottom that I traded that we'll discuss later. But here we have a very powerful gap up on earnings, and you could have had an initial risk that was relatively tight, or you could have used the deeper one that was halfway of the pattern. If you bought the closing basis, this is an example where you would have been stopped out on the closing basis buy. So that's one of the negatives, although it provides a lower risk entry, and that worked in the Lulu and the Facebook example and the Fastly examples. In this case here, Netflix did consolidate a little bit before moving higher. So here, buying the open and having the larger stop placement would have worked in your favor. Both have their pros and cons. Sometimes the smaller risk is great because you can get a multiple of that risk much easier, but there's the trade-off of being stopped out more often. It becomes a personal preference as to which way you want to play the position or how you want to structure your trading plan. I would just recommend that when you go into the stock or when you use this pattern, you have that sorted out in your head and in your plan before you start using them, or emotions may take hold and you don't want to be changing your initial stop as the stock's moving against you. So you really want that set in stone prior. But even with the larger riskier of 77 cents, we relatively quickly had a 5 times your risk move, then 10 times your risk move. And that allowed you to really sit through this market correction where Netflix showed an immense amount of relative strength. And I actually ended up buying this stock through this double bottom months later. So if you were paying attention earlier on and caught this gap up, you already had a substantial cushion before you could have began adding to the stock at later buy points. And we'll see how all of that comes together. But again, it's just important to see how powerful an earnings gap out of a shaping base can really be for a stock price. This is the last example of the buyable gap up coming out of a basing structure. So we had Square going sideways for quite some time. And we can see here we had our earnings report and we gapped up on huge volume. And this is another example of the trade-off between buying on the close or buying on the open and where you have your stop placement. So this is a reason why I tend to like buying the open, as I mentioned before, and keeping the wider stop placement. If you bought the opening gap and you placed your stop midway of that gap, you were never stopped out. Whereas if you bought the closing basis and used the opening price, you were stopped out here on the slight pullback that occurred, which is normal and does happen relatively often. It's that trade-off. So even if you use the wider stop placement, you had 5 times your risk a couple of months later and eventually 16 times your risk. And to think that you got such a multiple of your risk by using a relatively wide stop placement is still a pretty powerful thing. And it really shows how strong and powerful a gap up out of a consolidation pattern can be. So the next pattern I want to discuss is the 3-touch trendline break. So in the prior tactical session, we used a similar pattern, which was the coil triangle. And that's really unique in the sense that the whole pattern is really coiling up. But just because you don't have that tightening of volatility doesn't mean that the pattern can't work for you. And it's such a simple tool and it's so effective. I really wanted to show both variations so that you won't miss this opportunity if it comes around. And I really tried to use all of these different tools that, again, many of these are not groundbreaking or unknown of, but it's really putting them all together in a holistic system that makes them so powerful. Now, this is Mosaic, which is a fertilizer company. And back in 2006, 2007, the fertilizer stocks went crazy because, again, the rise of China, grain prices were rising, and the whole commodity space was just very, very strong. And this stock advanced 1,000% in less than 2 years, tenfold move. So really life-changing advances. And throughout this entire advance, you had 3 very noticeable consolidation patterns. And you could have entered in all of these patterns really cleanly, very easily with a controlled risk by using a 3-touch trendline break. So let's take a look at each of these patterns individually. So this is that first pattern way at the beginning of the entire run of the stock. And you can see this was actually a 4-touch trendline break. And I tried to zoom in here so you could really get a sense of how it looks when you actually buy the stock. So here you have that green trend line coming down. This was the 4th touch that you can see down here in the chart. And as you got through that trend line, you had this very strong up candle. And I would be placing my stop at the low of that breakout day. You can buy it on close. Some people like to buy it as the day is progressing. I think it's safe to say you can just buy it on the close as well. And ideally, I always appreciate it when the stock is not only taking out the trend line, but the last touch point. So that has the twofold strength of taking out that trend line and taking out the last resistance point along that trend line. That's really the ideal way to see it, but it's not always so clear to do it that way. And so you had an initial 50-cent risk, and relatively quickly you had 5 times your risk. So it was a very powerful move after it was purchased. But this really kicked off the entire advance of Mosaic, that 1,000% advance. And you came out of a shaping pattern, a consolidation, and really that was just a perfect way to enter the stock with a low risk entry point. After our relatively strong advance, the stock basically doubled in a few months. We went into a sideways consolidation and we had a 4-touch trend line. And if we look at that buy point here, we can see we kind of gapped up from one day to the next as the stock started to advance. And you could have bought above the prior touch trend line, or you could have bought on the opening or the close. For simplicity's sake, I say, buy it on the close, just so you can have a very strong understanding of the framework of how to apply it. But even if you bought on the close, you had an initial risk of only 70 cents at the low of that bar, which was very manageable. And very quickly, you had 5 times your risk. And we know that this stock went on to be a huge winner. So looking for that multiple touch trend line, again, 2 touch points are just not enough. You absolutely need 3 or more. That third point confirms that that trend line is valid and is an actual point of resistance for the stock. So after we had that enormous advance, Mosaic just wasn't done yet. And so we had this down trend line here once again. We buy on it got close to the prior high here, but never closed above the trend line. So that's why, for simplicity's sake, let's discuss about having a stock closing above the trend line, because there's so many variations. Also, this was really just before earnings, so you wouldn't have bought the day prior to earnings, if you want to control your risk properly. So we gapped up out of earnings, we get a small earnings gap, and we close above the trend line in the prior resistance, and very quickly we get a 5-fold move. That 5-fold move is based on keeping your stop below the low of the gap day, because the price action is pretty volatile after an earnings gap. Even if you had put your stop below the low of the prior day of the gap up, you still would have had a 5-fold move as the stock advanced into June. So really, it's a very powerful pattern. Those 3 touch points give a great alternate entry. You're not waiting for the high of the prior base structure, and you have a good way to get in as the stock is advancing on the right side of that base and accumulation is re-entering. So we'll stay with another commodity-based stock in this next example. We had another great 3-touch trend line break. This actually, again, was 4 touches. And you can see here that we took out the prior high of the basing structure and closed above the trend line on the same day. Here is a zoomed-in version of that. Here we're going to take a look at Coupa Software, which is a great software name for the past couple of years. And we had the stock consolidating along with the market as the market was in a downtrend in late 2018. And we began to see some really strong relative strength where the stock did not make lower lows, whereas the market did. And here this was a very powerful trend line where we had 5 touch points. And you can see we broke above the prior high as well as closing above the trend line on the same day, which is really the best combination of having the two. And you could really buy above the high of the last touch point in this case. I don't always wait for a close above if I get both of those coming together. And we'll always place that initial stop below the low of that breakout day. So relatively quickly, we had a $2.25 risk. We very quickly had a 5-fold move relative to our risk, and soon after that, 15-fold move compared to our risk. So again, very strong pattern. It allowed you to enter relatively close to the lows of the basing structure rather than waiting to try and buy above the prior highs like most people traditionally do. This is the last example we'll look at here. So this is Redfin, again, one of the very strong stocks in the 2020 bull market. And we went into a nice consolidation here. We had a break of the lows, so we shook out a lot of market participants, and we were forming a cup structure. And we had these 3 touch points. Again, if you look at a zoomed in version here, we broke above the prior high and the trend line on the same day. It's your choice whether you want to buy above the prior high or wait for the close. Either way, it's a relatively controlled risk. If you bought above the prior high, you had a $1.50 risk. If you waited for the close, you had a $2 risk. Very quickly, you had 5 times that risk, and soon after that, 23 times that risk. So again, if you really wait for these low-risk entry points, it's not that difficult to get that initial 5 times your risk like we spoke about way at the beginning of this course. And it's important that you keep your risk very tight in order to do that, and that's what these patterns really help to deliver. So we discussed gap aways from bases as our first breakout pattern, the break of the 3-touch trend line as our second. The final pattern I want to look at here is the 50-day moving average volume breakout. So again, you want to be part of a consolidation period here, a shaping structure. And what you want to see is you want to see the stock break above that 50-day moving average. You can buy on the close, and you really want to see a volume increase for this. So the 50-day moving average is really an important average that institutions watch and many investors are always focusing on. And the ability for a stock that's been under that average for at least several days or several weeks to close above that average with increasing volume really shows that there's a character change going on in that stock price. And so we can see here, this really kicked off this move higher in the stock. This is Coupa Software in 2018. And you had a 203% above average move. So whatever the average volume was, it was 200% higher than that. The initial stop will be the low of the breakout day once again. But even though this was a large range day, the move is so strong that you very quickly got 5 times your risk. And soon after that, you had a small consolidation and we went much higher. I want to stick to Coupa here again to just show how these patterns can really reoccur over and over again on the same stocks and give you multiple entries. Soon after, we had another consolidation here. This is off the COVID bottom in 2020. And you can see this was consolidating sideways, and it was really this gap up and break through the 50-day moving average with substantial volume that really kicked off this advance in the stock price. So you had a relatively low risk. You could have put it at the low of the day with a $9 risk, and you soon after had a 5 times your risk move. So it's very powerful. It's easy to just buy this on the close of the day. So even if you're busy doing other things throughout the day, you can kind of flip and look at the stocks of importance. And it's really highlighted by the fact that the volume was 63% above average. So crossing that 50-day threshold with big volume coming out of a consolidation is a very powerful pattern. EXPI was another extremely strong stock in 2020 and had a major advance. I just want to give you a view of how these are not always picture perfect. So you can see here EXPI began to correct lower, and we pulled back to the 50-day moving average, and we had a quick blast higher through the 50-day with increasing volume. Volume was up 76%, and it closed above the average. If you bought above there, you were stopped out within a couple of days. Now, sometimes there's just no way around being stopped out. You can also look at the fact that you weren't coming out of a consolidation period. This was just a pullback to the 50, so sometimes those are a little more failure prone. Once it's consolidated for a little bit more time and put in the time that's required for a proper base to form, we had a big break through the 50-day moving average once again. Volume was up 110%, and you could have had your stop at the low of the day, which was only $2.65, and relatively quickly you had a move that was 5 times your risk. So not always perfect, but if your losses are 1 time your risk and your gains are 5 times your risk, it's well worth paying attention to this very powerful pattern. I want to tie in the 50-day moving average break with some of the other patterns we looked at. So we already discussed this 3-touch trend line break on Mosaic, but sometimes if you don't notice one pattern, a lot of these tend to come together at the same time as this stock is really being taken back into control by buyers. And we can see here that as this trend line break happened, we also had this big push through the 50-day moving average, and volume was up 172%. So even if you missed this line, which sometimes people's eyes are not as accustomed to finding these trend lines on a chart, and it does take some practice, you really had this break of the 50-day that was really clear and really easy to see. And the volume really highlighted that. You soon after had a move that was 5 times the size of your risk, and not too long after that, 9 times the size of your risk. So very powerful pattern, and I always love to see when these come together because it really strengthens the overall picture that is being accumulated.